Okay. Okay, can we start, please? Shall we start? Would you like to come in or sit down, maybe in this? Okay. Thank you. Ladies and gentlemen, welcome. Special word of welcome to the Chief Operating Officer, Professor du Plessis, and the Dean, Professor Woolard. The department is delighted to welcome you all to this special guest lecture by Professor Lesetja Kganyago, Governor of the South African Reserve Bank. Before we proceed, at this particular occasion, it is appropriate for us to briefly reflect on what has been a sad week for the monetary policy community and for the country at large, following the unexpected passing of Professor Tito Mboweni, former governor of the South African Reserve Bank, former finance minister, and here at Stellenbosch also an honorary professor. So may I request that we observe a moment of silence out of respect. Thank you. Professor Kganyago, welcome back to the university. We are twice honored today. Not only is Professor Kganyago honorary professor of economics here at Stellenbosch, he was also conferred an honorary doctorate in commerce by our university in 2018. For his singular contributions to economic policy making in the country. Professor Kganyago is an internationally revered policymaker. He is the governor of the South African Reserve Bank since November 2014, and he has been a bastion of stability, I think, during a decade of particular difficulties in the country. Among others, he chairs the Committee of Central Bank Governors of the SADC region, and co-chairs the Financial Stability Board's Regional Consultative Group for Sub-Saharan Africa. Before being appointed governor, Professor Kganyago was the deputy governor of the bank for 3 years, and prior to leading the bank, he was Director General of the National Treasury, where he led key public finance and financial market reforms. Today, Professor Kganyago's deep experience in monetary policy making within the inflation targeting framework will reflect in his lecture titled How the SARB Moved Inflation to 4.5% and What It Cost. Professor Kganyago, you are most welcome.
Thank you very much, Professor Boshoff, and the academic community of Stellenbosch. It's also good to see some retired jerseys back here. Former board member of the South African Reserve Bank, Professor Ben Smith, who has also discovered that the longer the title, the more useless the position, because he is now called Professor Emeritus. Some of us are called honorary professor. You can see the title is getting longer, and so that becomes useless. Good afternoon. When I was asked to come and speak here, I struggled to find what I should talk about, and I decided to retreat into my comfort, which is monetary policy. So my subject today is lower inflation. It is a major global theme. We have experienced the biggest inflation surge in decades, and now policymakers are looking back at lessons learned. I want to reflect on these lessons I also want to discuss the South African experience with lower inflation. For that, I will focus on our move to 4.5% as the midpoint objective of monetary policy, a change we introduced back in 2017. All of this is relevant to our ongoing discussion about inflation target and the desirability of moving to a lower target in line with our peers. The first lesson from the global inflation is that people really hate inflation. We always knew inflation was bad, and we always knew the public disliked it. Still, many economists have been surprised by the depths of public unhappiness with high inflation. This has been especially clear in advanced economies that had very low inflation over a sustained period, usually 2% or less. At those rates, most people did not have to worry about inflation. But after the COVID-19 pandemic, they suddenly experienced the kind of price increases usually found in poorer countries, and they hated it even more than expected. They objected when prices rose, and they were disappointed when they did not fall again afterwards. They felt their wages had not kept up with inflation. They objected that it would have been easier to cope with a recession. It is a strong reminder to central bankers that the public like price stability and they dislike inflation. A second lesson is about the effectiveness of monetary policy. What works and what doesn't. Something that didn't work was the transitory argument. The claim made in 2021 that high inflation would be temporary and there was no need for a monetary policy response. As Jerome Powell said in his Jackson Hole speech this year, the good ship transitory was a crowded one with most mainstream analysts and advanced economy central bankers on board. You will notice he exempted emerging market central bankers who were most used to severe supply-demand imbalances and their inflation consequences. The fact is, the good ship transitory sank in the inflation storm of 2022. Fortunately, everyone on board escaped to another vessel, joining the emerging market central bankers with the aggressive inflation-fighting policies. Another failed claim was the 2022 argument that inflation would come down only through a severe recession with a big increase in unemployment. In fact, inflation in major economies like the United States fell from about 9% to just over 2% with no recession and steady job growth. Looking at this record, you would say that central bankers either got it right or they got it lucky. My sense is that central bankers made their own luck. There is no question that supply side factors helped. We had lower oil price inflation, lower food price inflation, and better supply chain functioning after the COVID-19 disruptions. But it is equally clear that the monetary policy response is part of the story. Forceful policy responses put the brakes on inflation. They also helped convince the public that central banks were committed to low inflation and that high inflation was an aberration, not the new normal. In the language of the Bank for International Settlements, central banks managed to get back to a zone of stability, averting a switch to a high inflation regime. The lessons are, it was wrong to say we could have low inflation for free, that we could just look through shocks, keep rates low, and all will be fine. But it was also wrong to say that lowering inflation would require a recession and large-scale job losses, as soft landing was an attainable goal. What we have seen is a reminder that good monetary policy can deliver low inflation at a modest cost. It does that by safeguarding the low inflation regime, which has its own self-stabilizing properties. Given how strongly people dislike inflation, this is clearly the space we want to occupy. Let me now turn to our own inflation experience. South Africa implemented inflation targeting nearly a quarter of a century ago in 2000. Looking back, the framework has been generally successful. Both inflation and interest rates have been lower than they were before inflation targeting. Inflation has also been within the 3 to 6% target range on average. However, the average has been on the high side of the target range. Since 2000, using the targeted inflation measure, it has averaged 5.85%. We have also missed the target quite often, almost exclusively on the upside. We have been above the 6% upper bound of the target nearly 40% of the time, compared with only 1% of outcomes below 3% lower bound. When we reflected on our record, soon after I was appointed as governor, we identified 3 shortcomings. First, we were missing our target too frequently. Even though 3 to 6% is one of the wider targets around the world, and therefore should have been relatively easy to hit most of the time. Second, our average inflation rate was high. Inflation was mostly near 6%. This did not amount to a crisis. It was much better than the double-digit rates seen in the 1980s and 1990s. But it was not good. At 6% inflation, prices double in just over a decade and triple in 2 decades. No one could confuse that with price stability. Since we are in a lecture hall and you are taking notes, let me repeat this. Our average inflation rate was high. Inflation was mostly near 6%. This did not amount to a crisis, and it was much better than the double-digit rates seen in the 1980s and 1980s. But it was not good. At 6% inflation, prices double in just over a decade and triple in 2 decades. No one can confuse that with price stability. Third, we realized that the economy had a structural growth problem. After the global financial crisis, South Africa's growth slowdown was diagnosed as a weak demand problem. To deal with it, we tolerated higher inflation so that we could avoid rate increases and restore growth. It did not work. Growth never came back. We just ended up with high inflation. Accommodative monetary policy was the wrong medicine for the patient. These hard truths prompted us to try a new approach. From 2017, we began emphasizing that we wanted inflation in the middle of our target range at 4.5%. We would not treat 3 to 6% as a zone of indifference, which in practice meant aiming for the top of the range and going and ignoring the bottom half of the range. Rather, we were explicit that we wanted to be at the midpoint over time. The range would be there to handle volatility, which is inevitable with inflation. But over time, the SARB would always be working to bring inflation back to 4.5%. To make this point clear, we put it in the Monetary Policy Committee statement and our Monetary Policy Review. We discussed it in speeches. We also adopted a new flagship forecasting model, the quarterly projection model, which included a midpoint of an explicit 4.5% objective and projected a path for the policy rate that will deliver on that goal. The new strategy worked. Over the next few years, we achieved lower inflation and we also secured broader stakeholder understanding of our revised objective. Between 2017 and 2019, we recorded many more mentions of our 4.5% objective. For instance, from experts and journalists, in analyst reports, and in news articles. No longer did anyone have to write scholarly papers to estimate our implicit target. We communicated exactly what our target was. It was explicit. And inflation slowed. In 2016, annual inflation was 6.3%. That fell to 5.3% in 2017, 4.6% in 2018, and 4.1% in 2019. By the time COVID-19 hit, the latest monthly inflation print we had in hand was 4.5% exactly. The strategy worked. Inflation expectations also declined significantly from near the top of the target range to around the middle. For instance, at the start of 2017, 2-year ahead survey expectations were at 6%. At the beginning of 2020, that measure was down to 4.8%, and by the end of the year, it was 4.5%. Need more convincing? No. The strategy worked. We were clear that we wanted inflation at 4.5%, and we delivered. This experience demonstrated some lessons that remain important today. These are lessons about the cause of lower inflation, about structural factors like high administered prices, and about the role of monetary policy in shaping trend inflation. I'll start with the influence of monetary policy over inflation. If you go and ask people what causes inflation, you will often get answers about food or oil prices and other such supply-side factors. Yet, all countries face these shocks. Nonetheless, different countries have different inflation rates over time. Sometimes, very different inflation rates. It is easy to understand moves in inflation caused by something like the petrol price. But over longer periods, such as 10 years, these factors mainly create volatility, nothing more. For the long run price level, it is the central bank that must take most of the responsibility. Yet, because the inflation process is not always well understood, monetary policy is not held adequately accountable, and our stakeholders are not fully aware of what they can ask us. Let me give a simple numerical example. In 2000, both Chile and South Africa adopted inflation targets. Underline that Chile and South Africa, we both commodity producers. Chile went for a target of 3%, and we went for a range of 3 to 6%. Since then, our inflation has been higher than Chile's by 1.8 percentage points on average. Chilean inflation has been a bit under 4%, whereas ours, as mentioned earlier, has been closer to 6%. This may not sound like much of a difference, but if you look at price levels, Chile's prices are now 2.8%, 2.8 times what they were in 2000, while ours are, 4.5 times higher. Both have increased a lot, but ours has increased much more. It was not that we faced a higher world oil price or a higher wheat price than Chile. And both countries had professional, independent central banks. The difference was that we had a higher inflation target. This comparison takes me to the subject of administered prices. In South Africa, we have a range of prices set by government for services such as water and electricity. These items tend to have high inflation well above our target. If you start talking about lowering the target, a standard objection is, what about administered price inflation? You cannot control administered prices. If you aim for lower inflation, you will hurt the rest of the economy. We had this a lot back when we started aiming for 4.5%, and we also hear it now in the ongoing discussions about moving to a lower target. Unpacking this issue, it is important to realize that higher administered price inflation negatively impacts everyone, whether the target is 6% or 4.5% or 3% or whatever it may be. High administered prices affect all of us. What we are seeing with administered prices is known as a relative price adjustment. Essentially, these goods and services are becoming more expensive relative to others. When this increase stems from inefficiencies and the pricing power of monopolies, it is detrimental both to the economy and to consumers. This is an important part of the reason we have long called for lower administered price inflation. However, it does not mean that the administered price inflation problem is worse at a target of 4.5% than 6%. Similarly, raising the inflation target will not necessarily improve the situation. If you have a higher target, you would expect all prices to rise faster across the economy. You would expect your currency to lose its buying power for global commodities such as energy and food faster. You would expect more currency depreciation, meaning your currency would become less valuable compared to others that hold their value better. In these circumstances, administered price inflation would likely increase. Price setters, still intent on making relative price adjustments, would still have the power to do so and would simply implement even larger price increases. If the situation is turned around, it becomes clear how it is possible to achieve lower headline inflation even with high administered price inflation. The overall price level rises more slowly. The currency depreciates at a slower pace, and the rate of administered price inflation slows even as the wedge to other prices remains. This is what we observed in 2017. Headline inflation slowed, and so did inflation for administered prices. The gap between the two was largely unchanged. From 2010 to 2016, the gap was 2.4%. Since 2017, it has been 2.3%. Of course, administered price rises. The administered price series is heavily influenced by global oil prices, which are not quite administered, or at least not by the South African authorities. Even excluding the fuel price component, administered price inflation was lower after 2017. Whether looking at water, electricity, school fees, or vehicle licenses, administered price inflation was lower after 2017. On average, the difference closely matched the amount of total disinflation we achieved, 1.5 percentage points, with headline inflation slowing from around 6% to 4.6%. Does disinflation negatively impact the rest of the economy if administered price inflation is high? It is important to remember that administered prices make up about 16% of the consumer price index basket. It is an important category, but hardly a dominant one. If we want 4.5% inflation and administered prices are stuck at 2.4 percentage points above headline inflation as they have been, that means other prices can only rise by about 4%. For 3% inflation, the same calculation gives an inflation rate for other prices of about 2.5%. In other words, you do not have to push the rest of the economy into deflation if you have high administered prices. You just need everyone to implement smaller increases. Of course, it is highly desirable to have lower administered prices, and it is easier to have lower inflation and lower interest rates where these categories are helping and not hurting the disinflation effort. But let us not pretend we must live with a relatively high inflation target just because of our administered prices problem. It did not stop us from getting from 6% inflation to 4.5% inflation. This brings me to another concern about lower inflation, that the short-term costs are high. The expectation is that with a lower target, the central bank will raise rates, squeezing the economy. Unemployment will then rise, firms will be unable to raise prices because of weak demand, and so inflation slows. This trade-off between growth and inflation strikes some people as unacceptable, even when they understand that lower long-term inflation would be desirable. It is therefore interesting to consider what it cost us to get to 4.5% from the 6% that we had. In the real world, it is difficult to test the counterfactual. We cannot go back in time and conduct an experiment where we kept on aiming for the top of our target range rather than the middle. We do, however, have a study where two economists considered a counterfactual model. Their work compares actual outcomes with how the economy was likely to proceed without the 4.5% change. The results make for interesting reading. Perhaps the most striking is that the authors find no reduction in aggregate demand during the move to 4.5%. Growth in gross domestic product is in line with the counterfactual. Unemployment is generally unaffected, but credit extension is higher. Their conclusion is that there was little or no cost to getting inflation to 4.5%. And the explanation they provide is that the SAP's commitment to 4.5% was heard and understood. Inflation was not forced down by a recession. It was managed lower by clear and credible policy and communication. This conclusion lines up with another study by the South African Reserve Bank economists of sacrifice ratios in South Africa. A sacrifice ratio is the cost of reducing inflation measured as the annual amount of GDP growth lost for each percentage point of lower inflation. For the period where we moved inflation to 4.5%, this study finds a negative sacrifice ratio, which means there was no cost. The authors also find that disinflation costs have generally been low in South Africa. This is once again contrary to the popular intuition that lower inflation is achieved by slower growth and higher unemployment. And once again, the key seems to be the SAP's credibility and communication. If the public understands and believes the central bank's objective, disinflation can be achieved with little or no pain. Ladies and gentlemen, let me conclude with a summary of the lessons learned, which should be informing our current macroeconomic conversations. First, we have a relatively high structural inflation, but it is not an inevitable thing and not a policy choice. But the fact is, we would have a lower inflation target like almost all our peers, and with it, lower inflation. If we achieved this, I think South Africans would enjoy the lower inflation experience, and we look back at an era of inflation generally over 5% as a period of great inconvenience and difficulty. People prefer price stability. We cannot honestly claim that we are delivering that. We can do better. Second, in discussing inflation in South Africa, analysts too often misrepresent the administered price problem. Yes, administered price inflation is too high and damaging for the economy. Yes, if it were lower, that would help deliver lower inflation and lower interest rates. But administered prices are also responsive to economy-wide inflation, and they are not such a large part of the basket that disinflation can only be achieved by forcing everyone else into deflation. The conversation about lower inflation should not be held hostage by administered prices. Third, it is still often assumed that lower inflation means lower growth, despite rigorous studies showing that sacrifice ratios can be low. It is depressing enough that short-term pain is considered such a decisive argument against long-term gain. But it is even worse that it is considered a winning argument when it is not even clear there is short-term pain. The studies of the move to 4.5% inflation certainly do not show high costs of moving to a lower inflation target. They show a path to lower inflation that relies mainly on communication and credibility rather than high rates. Overall, I think these three misconceptions leave us with a macroeconomic discussion that is too pessimistic and insufficiently ambitious. We have an opportunity to achieve permanently lower inflation and therefore permanently lower interest rates. Executed effectively, a lower target could be achieved at little cost, just as we moved to 4.5% at little cost. Ladies and gentlemen, this is a season of reform in South Africa. For any successful reform, you need to start with ambition and conviction. And then you need to follow that with great care and responsibility to get the execution right. I hope with this talk, I have helped us find our ambition and conviction so we can move on to excellence in delivery. Our people deserve better. A lower inflation brings price stability, and our people expect nothing less. Thank you.
Thank you, Governor, for that forceful delivery. The Governor's indicated that he's happy to take a few questions, so let's hear from the audience. Yes, would you like the mic? Should I give the mic?
Thank you. Yes, on behalf of all that are here, thank you so much for your time, Governor Kganyago. My question is more of a request for guidance more so, given that a lot of the students around me have the consensus, not all of them, but a lot of them, that when we graduate, we're going to look to export ourselves to overseas labor markets due to uncertainty of the future of our country's economy. Is there any words of wisdom aside from all of these great figures of our inflation reports that you could give us to quell that uncertainty to stay in the country that we love so much?
Shall we take like 3 or 4 questions?
Greetings, Governor. Given that you've said...
Just because the disadvantage I have is that I was introduced, so you know my name and I don't know yours. So
okay. Greetings. My name is Kamogelo Majahe. So given that you've talked about talking about lowering the inflation target, what would you say would be the new ideal target for South Africa? Should it be like the 3% of the lower bound of the current one, or move towards a 2% inflation target in line with our trading partners like America, for example?
Afternoon, Professor. Considering that you are nearing the end of your term as Reserve Bank Governor, your second term, is it within your remit to consider lowering the inflation target more, or are you leaving that for whoever may succeed you?
I have a new term ending in 2029.
In which case, are you considering further lowering the inflation target?
Good afternoon, and thank you for the insightful presentation. My question is, given the lower trend in economic growth for South Africa, there might be a concern that maybe has this midpoint target been assessed to see if it's in line with optimal economic growth for South Africa? So in essence, the question is, this 4.5 inflation target, is it accommodative for optimal economic growth for South Africa in the long term? Thank you.
Okay, shall we deal with those? Of course, you must stay. We have got significant economic problems, and we can do with a few economists to help solve those problems. That's one. And two, the weather in Stellenbosch. The weather in Stellenbosch is much better than in London. Three, London doesn't have a mountain. You are surrounded by mountains. So it's a beautiful country. More seriously, countries are competing for skills. And people will come here and recruit our skilled workforce. I see no reason why we can't recruit their skilled workforce. There are other people in other countries who will be happy to be in South Africa. And for South Africans who go out and work elsewhere, it's not a loss. One of the big things people talk about now for developing countries had been the role of remittances. You will not moving lock, stock, and barrel. You will leave some people, some relatives here, and at some stage somebody will say, send some pounds please, or send some dollars or euros, and it becomes an important. But it's important to explore the world out there, because sometimes we never know how much better our country is until we get out there. And so sometimes you must get out there to realize how much better our country is. Last time I checked the stats, they said something like 70% of STEM students in California are coming from outside of California. And when they finish, they just move into Silicon Valley. And Silicon Valley itself is full of people who are coming outside of that place. Because Silicon Valley had become a magnet of certain skills. Just as New York had become a magnet of certain skills, every art became a magnet of certain skills. So if you want to study the wine industry, you don't go to the University of Pretoria, because wines are in Stellenbosch. Okay? You here. And that is what you would face. We would attract particular skills too as a country. And it is important that those who would like to work here, we make it easier for them to come and work here. But the typical South African narrative would be, let's grow our own timber. Well, we grow the timber and somebody harvests it. So why don't we harvest their timber if they are harvesting ours? That's the... Ideal inflation target and the lowering of the target. What is clear is that the target can only be reviewed lower. It can't be reviewed higher. As I had tried to demonstrate to you, even at 4.5%, you will have prices double every so many years, and that becomes problematic. The setting of a target is not a simple econometric exercise. It also entails decisions that are taught outside of this faculty. They do call themselves scientists, but they are actually not quite scientists. They are teaching political studies. And it's about making the political decisions. And so to have a target that is optimal from a theoretical and academic perspective is one exercise. The other exercise is to also look at that target relative to the targets of your peers. Let me give you this statistic. As we are now, based on the inflation figures, in the G20, the group of 20 countries, South Africa is a member of those, and we are going to chair that next year. We have got the worst inflation rate of the G20 member countries except for two. Argentina and Turkey. And we beat them because their inflation is in double digits. And so what that means is, compared to our peers, we are actually out of line. In arriving there, thus at an optimum target, it's important that that optimal target is informed by rigorous work. That rigorous work, of course, which chaps can do it. They can also publish the things. But I do have people in the bank who are doing that work. There is another team that is doing that work in the treasury, and the two teams come together in a structure that the Minister of Finance and the Reserve Bank have to interrogate that and say, as we lower the target, optimally, where should we lower it to? Remember, the higher the inflation we have, the higher the interest rates that we are going to need. And that's because ordinary people look at nominal rates. It's us here who likes complex calculations, who think in real figures. Ordinary people, you can try and say that, oh no, if you look at this interest rate relative to inflation, it's so small. No, they are seeing the nominal rate. And so if you are to have a lower nominal rate, it is important that you have lower inflation. Why? Is because lenders and investors will always want to be compensated for inflation. And they hate inflation surprises. And what an inflation target does is that it gives them certainty that there is an institution in government that will bring inflation to that target. And that reduces the inflation premium that is embedded in the cost of borrowing. Going to a lower inflation and the impact on trend growth. Well, if you're going to a lower inflation because you are taking particular policy measures to get there, you will not quite affect trend. It's important to understand this. Monetary policy affects growth in the cycles. And it's important that we understand a very important concept, much as it is an unobservable variable called the potential growth rate. And the potential growth rate, if you think of it, you can think of it as the speed limit on a road. So if the speed limit in a particular zone is 60 kilometers per hour, it's because the road engineers had felt that there are particular risks with around here for driving above 60 kilometers per hour. Either there are dogs, or there are animals, other animals, or there are people, or the road is not straight. A skilled driver might still be able to drive on a 60 kilometers per hour road at 80, 90, or even 100. But to do so, you do it at a risk. You do it at a risk of life or a serious crash because you are driving faster than the speed limit. And so, if you would like to drive faster, and the road is a bending road, what you need to do is to open the road so that we can raise the speed limit to 120. And then it is safer for you to drive at 120. If your potential growth rate is 1% and you grow your economy by 2%, we will say you run a positive output gap, and it could only lead to higher inflation. And so monetary policy must bring the economy back to its potential. And if the economy has dropped below potential, monetary policy must stimulate the economy to go back to potential. And so when people say we need stimulatory policies in South Africa, ask them, where is the potential growth rate and where is our actual growth rate? And the problem we have in South Africa is that potential has eroded so much that our potential growth rate is low. We had estimated it in the Reserve Bank at 1%. We now think that it has gone up to 1.3%. That means that an economy that probably just grows at 2% could result in a rise in inflation. And why was I talking about structural constraints is because if you alleviate those structural constraints, you would lift the potential growth rate so that you were growing at 2%, but now the potential growth rate is no longer 1.3%, it is, say, 2% or 3%, then you can keep on trying to get to that level. And those structural reform, if you go back to our analogy of the road, could amount to straightening the road or putting a bridge or putting a pedestrian bridge so that the pedestrians do not walk on the road and you run the risk of knocking them. It could entail putting an animal gate so that the animals do not get onto the road. And yeah, your lecturers complicate these things. They call them structural reforms, but I hope you understood it. Can we take another round? Yeah. I'm cognizant people must go and learn real economics and not monetary policy.
Thank you, Governor. Zakele Ngobo. Just wanted to know what's the, since we have dropped so much our inflation, what is our ability to deal with economic shocks? Say another economic shock as big as COVID-19 happens today or tomorrow in a short frame. Will the bank still have the capacity to deal with it?
Good day, Governor. Thank you for your lecture. My question is, to what extent is the SARB's current monetary policy helping or hindering access to credit for SMEs and low-income groups? Following on, would an aggressive expansionary policy, like a hypothetical rate cut of 50 basis points, spur higher inflation volatility in the short term? And would that opportunity cost be worth it for a target goal of 5.4% growth rate by 2030?
Hi, it's Zamani Zwane here. So I have two questions. The first one, so given that the economic decisions by consumers, investors, and financial institutions is often influenced as such by perception of inflation, I'm curious about the extent to which the Reserve Bank incorporates psychological insight into policy assumptions. Specifically, how much do you invest in understanding the psychology behind how people form these perceptions about inflation, economic stability, and future expectations? Yes, do you actively incorporate studies or expertise from psychology to refine your communication strategies? Because there's studies that show the influence of communication, how you communicate, how the influence of how you communicate to how the people receive and respond to what you're communicating. So how much, to what extent, if you do you incorporate that in your decision making? And then,
Thank you. Shall we take one last one?
so I had two questions.
You want to have the last word?
No, I was saying I had two questions, but the second one is like more straightforward. So I wanted to ask, so what are some of the unresolved or unanswered questions that the Reserve Bank or you as the governor believe still need further investigation or exploration? I ask this because I think understanding these gaps can help us, whether as students or future researchers, contribute to finding solutions. So this insight could also guide our academic research, even our lecturers when they're selecting the topic list for the essays, theses, or dissertations that we write. So in your view, what are the areas where more collective thinking and innovative approaches could help improve our economic policy framework? Thank you.
Hi, Governor. Thank you so much for the speech. My name's Ross, and I just wanted to ask, according to some of the more recent data, we were at about 4.4% of inflation around August this year. And I just wanted to know, what is the mindset behind the 25 basis point reduction that you guys made last month? Are we looking at a more expansionary future for the next couple months? And maybe are you guys looking at continuing reducing interest? What was that mindset? I just want to understand, see where our future is, expectations.
Thank you very much. Since you are a student, I will take it you are not speaking on behalf of the borrowers. Where we are with inflation, does that give us the space to deal with the shocks? Our current assessment is that our monetary policy stance is still restrictive. And it is restrictive because going forward, we had assessed the risks to the inflation outlook. And what used to happen with central banks is that central banks would put a forecast of where they think inflation is going to be, and then they will put bands around that. Something is called a fan chart. So you have a central thing, and then it will take confidence levels to away from the central forecast. It's been a preferred approach by central banks. But in the COVID aftermath, it didn't become particularly useful because it couldn't quite deal with the shock. And the approach that central banks have now been taking, which is the approach we are also taking in the Reserve Bank, is to say, what are the risks that could result in a higher inflation, and what are the risks that will result in a lower inflation? If all the risks that result in a higher inflation materialize, what will the inflation trajectory look like? So we will call that the high inflation scenario. And then the ones that could lead to inflation being lower than our forecast, we will call that the low inflation scenario. The monetary policy stand is determined on the balance of those risks. If the shocks come, it's going to be another matter. And the shocks, it all depends on the shocks. COVID was a shock that happened once in 100 years, where you had like the world shut down completely, and there is no move. We think that where we are, if there are shocks, we will have to deal with the nature of the shock. So it's not possible to say you can deal with all of the shocks. And by the way, bear in mind, not all the shocks are negative. There are also positive shocks that can take place. And you must respond to the positive shocks as well. Meaning, where you have shocks that drive inflation lower, you need to be able to respond to that. It's a question of I hope is not a psychology student looking for a job in an economics institution, but which says that how do you bring in the psychological parts in it. At its point of departure, economics is the study of the behavior of economic agents. And unlike the psychologists, we don't assess your mental state, but we assess what you are most likely to do. And so we do not know what people will expect inflation to be in the future. We do not know what people expect growth to be in the future. We spend a lot of time trying to understand what people think inflation will be in the future, because that drives whether they decide to spend or to save. And so there are a couple of ways of doing it. One is to run a survey of the price setters to ask them, what do you think will happen to inflation in the future? We ask them over the next 1 year, over the next 2 years, over the next 5 years. We ask them those things. But if we tell you that that is what we expect the people will do, you will not trust us, because it's like we are a player and referee at the same time. So we outsource that to the Bureau of Economic Research here in Stellenbosch. They run a survey for us on inflation expectations, and they break it down between trade unions, businesses, and market analysts. And of late, we also want to understand the thinking of the households. And when we say we are talking about inflation expectations, and that inflation expectations tell us a lot about what inflation will be in the future, that is what we use. But that is a survey. Surveys also have got their own problems. That is one. The other that we then use is what we derive from the financial markets. We call this break-even rates. It is the difference between the government's nominal bond yields and the government's inflation-protected bonds, inflation-linked bonds. And we impute what embedded thinking in terms of future inflation would be in there. And we feed those into our model and try to see how they would impact the outlook for inflation. So that's how we incorporate it. Communication, central bank communication has become a particular area of academic research over the past while, and it tends to roughly coincide with the adoption of inflation targeting across the world. But let's get something clear. You can't shout that we are going to have lower inflation in the future and therefore inflation is going to be down. You need the standing that we know when the central bank says inflation is going to be down in the future, they mean business. And if it doesn't go down, they will make it go down. And that helps in the communication. So your communication has got to be honest and be backed up by your ability to take actions, and that in the past you did take actions. So if you tell us one thing and you do the other, your credibility goes, and again, your professors will say to you, inflation expectations become de-anchored because you are no longer trusted. So you said this is the target. Your target is 4.5%, and for the past 3 years, inflation has been coming out at 6%, and you keep on telling us, no, inflation will get to 4.5%. Then the price setters adapt. They say, we've seen this movie before. When they say 4.5, they actually mean 6%. And therefore, they will move there. And before you know it, they add, and then inflation runs away from you. And then you are going to need stronger policy response to demonstrate your credibility to bring it down. The reason why after the COVID pandemic, when inflation started to rise in South Africa in 2021, we increased interest rates, but we were only increasing them by quantums of 25 basis points, 25 basis points, 25 basis points, was because we were riding on our credibility. And people, price setters, trusted us. They believed us. And today, the price setters will look and they say, oh, inflation is at 4.4%. This chap said inflation is coming at 4.5%. Oh, so they actually mean business. Right? Your professors would prefer that consumers do not think that way, because when consumers think that way, your professors say that they have got backward-looking inflation expectations. They prefer the price setters to be rational and look forward, right? But professors try very hard to get consumers to think rationally, but they don't. And you then, at the back there, raise a question about the mindset of recent policy changes. The easiest answer is in the MPC statement. And that's the legacy of Tito Mboweni, bringing us to explain every decision we have taken and why you didn't take the other. We have taken it a step further, that you will find not in the September statement, but in the July statement, we would say, this is what was decided. But there are so many people who thought that we should go a different direction, and here was their logic. But in this recent meeting, we banged each other and we arrived at a unanimous decision. So it's a constantly evolving thing, and the easiest way to put it to you is that it depends on the data. That is what it is. And so when you write your essay and the professor says, where is the data? You must understand where it comes from, the quantitative data. Access to credit, and we do not deal with access, because you see, we can't set interest rates for the SMMEs, for agriculture, for industrialization, for this. We set one rate for everyone. But without a doubt, there's a recent study that was done by the Bank for International Settlement that showed that globally, not before you even talk about access, that the small to medium-sized enterprises are under stress, because unlike the big corporations, they cannot hedge against the big movements in interest rate. The issue of access, I underscore, has more to do with the quality of the borrower rather than just what the cost of the credit is. Why do I say so? Is because the way in which credit is priced, it will involve a risk-free return. As we discovered, it is not quite as risk-free as it used to be, but that is the rate at which government borrows, and then compensation for how long you are going to borrow, and the last would be, are you able to repay? And that is the credit risk. And for small to medium-sized enterprises, it is that component that is the key driver of their access to credit. And but then you also asked the opportunity cost, and I spent time trying to talk about the sacrifice ratio. If we are to bring inflation down by 1%, how much do we lose in growth? It's a complex econometric exercise. As I had said, there are a couple of people who have done the studies in South Africa. They have showed that actually the sacrifice ratio is lower in South Africa. And that in itself is a very good news story, because it says that there is policy credibility. In an environment where you have got high inflation, that cost of bringing it down could come at massive costs to growth, and which is why the debate globally was always about whether to bring down inflation in the developed world must generate a recession to bring inflation down, or whether they can bring down the inflation without creating a recession and create what is called a soft landing. And it is a very imprecise science, or sometimes dismal science we apply, that is called economics, but those are the calculations we have to do all the time. There was a question about the gaps in economic, what are the things that, I know what our economic problems are. This economy is over-analyzed, the South African economy. There isn't a shortage of ideas on how to solve the problems, and the ideas vary from the most rational, pragmatic, to the weirdest you could get that you should not even consider, right? But you are looking for something that you will research, and I'm, to the absolute joy of your economic professors, let me give you this, that your point of departure is to go through a literature review, and you will find the gap right there.
Thank you, everyone. Thank you, Professor Kganyago. It was a fantastic hour, I think, and we all enjoyed it. Thanks for coming. Thank you.
Thank you, Governor.
Thank you.
There'll be a request for photos. We'll take one or two and then we'll go.
With who?
Okay?
Sir, Mr. Governor, thank you so much.
It's a pleasure.
Thank you so much.
Let me see those old men. How are you?
Sorry, sir. Do you mind if I get a picture with you quickly?
I'm going to be overcrowded. Everybody's looking for exactly the same thing you are looking for.
Thank you.
Prof, how are you?
Yeah, very good. That was so good. I'm listening to Estia now. You really.
How are you,
Good
Estia?
to see you again.
Good.
Thank you for mentioning that. That was fantastic. No, I'm good. I'm good. I'm not doing much, but I'm good.
The hunting season is out now, so that's why you are here.
You are being surrounded.